It's now my pleasure to invite Dr. V Reddy, former Governor, RBI, to deliver the CEPPF 10th anniversary address. The topic he'll be deliberating on is fiscal, monetary, and regulatory policies. Please welcome, sir.
Sorry, I'm accustomed to standing up. Friends, respected Modi ji, Professor Desauza, Professor Goendrao, Professor Mukherjee, my colleague, Mr. Siddharth, Mr. Singh, and other distinguished friends. At the outset, I apologize for the delay in coming over. In Japan, they have a system called JIT, that is just in time. They don't even unload or load. But now I said that now in our country, we don't have JIT, we have got SIT, somehow in time. and IST is generally described as not Indian standard time, but Indian stretchable time. So I think we are in the process of stretching, but I will do my best to confine to the time that I have been allotted, which has not been specified so far. Okay, having said that, I must also say why I chose this subject. The subject is fiscal, monetary, and regulatory policies. Basically, as we know, in the recent past, there has been a lot of debate about the fiscal policy, monetary policy, fiscal authorities, institutions, etc. So but there are some fundamentals, and I thought we should visit. Basically, they're supposed to be independent, fiscal policy independent, monetary policy independent, and regulatory policy is independent. I think they emphasized the independence. The rest of the world emphasized independence. They ended up with a crisis. So we didn't have independence, and we ended up with a low growth. After some time, we started changing that, and then globally also there's some change. But at the moment, I find there is some other type of change. So by and large, there is a bit of a confusion globally about the relative roles, especially the independence and the dependence. I think the confusion is at a different level. Global level is slightly different confusion from Indian level of confusion. So I'm trying to share with you my confusion about these two confusions. See, to go into preliminaries, basically the fiscal policy, just to recall, fiscal policy basically deals with the government's revenue, taxation, expenditure, borrowing, and influence the economic activity. What does monetary policy do? Monetary policy is in charge of basically ensuring the supply of money, the cost of credit, and ensure that there is trust in money and finance. And that's, the third is the regulation. Regulation is basically to see that the market rules are framed properly, the rules of the game are observed, and the idea is that there is a certain amount of independence so that people see if the government has the power to spend and power to create money, then there may be loss of trust and political cycles. So there is some logic. And people generally emphasize the logic for independence. But very often in this debate, we miss out the type of interdependence. So first, monetary policy. See, the monetary policy of central banks impacts fiscal position. Because all monetary operations, if you want to do, we are talking of liquidity, we are discussing liquidity. So liquidity is managed very often by the government, by the RBI, through open market operations. The open market operations means buying the government securities and selling the government securities. And when you sell the government securities and buy the government securities, not because you need it to influence the monetary conditions, you are influencing the rate of interest of the government securities. The government is affected. The government has to borrow. The government is issuing the government securities. So how can the government be totally indifferent to the open market operations of the RBI? It affects. I don't know why, how, and that's all different matter, but it affects. Their operations affect. Then the second thing is that you have the debt government. Secondly, the cost of borrowing by the government at any point of time. When the interest rate is high, if the RBI is keeping the interest rate high, very often we forget. If the interest rate is high, the government borrowing program also costs higher. So there is an impact on the government borrowing. So it is an interested party. It is an interested party. Third, then you have these interventions in the forex market. Whenever you have foreign exchange coming in, excess foreign exchange, you want to handle the exchange rate, then you have to sterilize it. When you sterilize it, there is excess liquidity. Then you have to suck in the liquidity. When you suck in the liquidity, you pay a price. And that price has to be borne by the RBI, indirectly by the government. So then you have fiscal, these are called quasi-fiscal operations of the RBI. So, and finally, central banks have what is known as the lender of last resort function. There's there is, as you know, the lender of last resort because of illiquidity. But the question is when you are operating as a lender of last resort, you are not sure whether it is illiquidity or insolvency. Sometimes you acknowledge the risk. Who bears the risk? The government ultimately bears the risk, though RBI is conducting the operations of lender of last resort. So I think these are the ways in which they impact each other. Similarly, we can say in the fiscal policy. Fiscal policy has implications. If government keeps on borrowing, then you will find that the amount available for the rest of the system is low, and the RBI cannot afford to have a situation, and it also has a possible implications on inflation, which in other words is the value of money. Then the domestic assets of central banks assets in their balance sheet are essentially government securities. And therefore, whatever the price of the government securities, it affects the balance sheet also. So now again, if you go to the regulation of financial sector and monetary policy, see, most of the regulators prescribe what is known as liquid assets. When any institution, so whether it is SEBI, they have or insurance authority, provident fund authority, they prescribe some liquid assets or some government securities, some percentage of government securities to be there. That means if the cost, the returns for all these regulated entities and the liquidity which the regulator is prescribing is affected by the operations of the Reserve Bank. So another interesting point is in a full service central bank like RBI, it is a monetary authority and a regulator of banks. In some cases, so it's operating on both sides in the same balance sheet. So my limited point is that there are many others I can explain, but basically if you get the hang of it, that they are good, they should be independent, they should operate independently, but their operations affect each other. And therefore, what is it? There must be some mechanisms by which each agency understands, appreciates what others are doing. So at a minimum, there should be continuous flow of information. At a higher level, ideal coordination. And still higher level, and coordination can be in the central bank, coordination can be in the government. At a higher level, there is planning. So that is the type of interrelationships we can think of in terms of hierarchy. Now, what is the global practice? Actually, we speak of independent central bank as though it is fundamental to the system. Actually, this idea of independent central bank, one objective, price stability, came up only in 1970s. In 1970s, because of a number of circumstances, oil price increase, euro-dollar market, collapse of the Bretton Woods system, and therefore advanced economies have had that as the biggest problem. And that was how it was brought into existence. So that's one thing we should be very clear. Now, when this was happening from 1970 onwards, everybody was happy because a lot of good things were happening, but they thought a lot of good things were happening because of monetary policy without realizing that it's because of globalization. So in a way, the net result is that the global financial crisis happened. And therefore, there's a rethinking. The rethinking is, as I mentioned, how to have appreciate the interdependence, how to have arrangements whereby they can cooperate, coordinate, at the same time maintain independence. That is and there's no agreed position yet. In the crisis, naturally everybody had to cooperate, but after the crisis, there's no agreed position on the balance between appreciating interdependence or coordination and independence. Now, let's come to the Indian story. Indian experience. From 1950, we had planning. Planning means the government determines what is required. So the RBI is asked to print money, they print money. And if they print a lot of money, then they have to kill money. Then they'll tell the banks to kill money. So it's pretty simple. So the issue of the fisc basically runs. The government runs the fisc, and the fisc runs everything else. And so that is a type of pattern which we had. And that is naturally, therefore, till 1990, apart from RBI and the Banking Regulation Act, we didn't have Securities Exchange Board of India, we did not have Insurance Regulatory Authority, all these things were not there. And there was a price to be paid because of sort of expansion or fiscal dominance. So after 1991, the reform basically had three things. One, fiscal consolidation. Try to have fiscal consolidation. Second, bring about certain amount of autonomy to Reserve Bank of India for its monetary policy. Create regulatory bodies and have a regulatory system. So these are the three pillars. For each one, there is a new logic. That is how the checks and balances were introduced. And how did this happen? The whole process happened in a very interesting manner in India. This is all discussed between RBI and the government. In fact, very often the practices preceded the law. There is an agreement, there is a discussion, there is an agreement. So basically the whole of the reform, monetary policy, financial sector policy, coordinating the fiscal policy, the whole of reform was done through mutual consultation, through agreement. And most of the committees called Narasimham Committee, ex-RBI Governor, Rangarajan Committee, again RBI, Tarapur Committee, Malhotra Committee. So it was, and the RBI as an institution provided the technical expertise as well as so RBI was the advisor to the government. And the government strategy was, through a negotiated reform, keep RBI, which is sort of semi-independent, make it more independent, keep it as the advisor, and keep the RBI as the coordinator. So the coordinator of the financial sector system was really the RBI. And that's why actually in 1992-93, a committee also was formed called Committee on Financial Markets with the governor as the chairman. So this is the broad pattern that was happening. From 2004, there was slight problem because there was certain amount of institutional change. In the world suddenly changed and a lot of capital flows were coming in. And at that point of time, there was some divergence. There was a divergence because the Reserve Bank of India felt that there is too much of enthusiasm going on and everybody wants low interest rates. And if you keep low interest rates too much and if you are too liberal, deregulation, the government world model, we will get into problems. But the government felt, no, your judgment is wrong. And so this pressure came. But fortunately or unfortunately, a compromise was arrived, giving more respect to the view of the RBI. Reluctantly, but it was agreed. Because the risk, the impression at that point of time, the political leadership felt that the risk of not agreeing is more than agreeing under the circumstances. So whatever it was, and later after the crisis, everybody agreed that was. So, but this is the balance. But everything was only through discussion, agreement, the reform. And later, of course, we had a couple of committees. I think Raghuram Rajan Committee and Justice C. Krishna Committee. So they are, of course, slightly independent. So in a way, the government has independent advice also, not necessarily the RBI loaded advice. So independent advice also. And I think this was the advice also available. So in a way, the government had choices to do different things. Then what happened, in terms of the balance, 2010 was the turning point. In 2010, FSDC, Financial Sector Development and Stability Council, Stability and Development Council. I think that was established. Financial Sector Stability and Development Council, what happened is it overtook it replaced. It's now presided by the minister. So the finance minister is the council chairman now. The governor is a member. The 3 or 4 regulators are members. Five or six people from the ministry are members. So in a way, therefore, the government directly took over the responsibility of coordinating the various regulators, monetary policy and fiscal policy. The coordination. Now, there are one or two issues here which we have to consider in mind, we have to keep in mind. One is that globally in emerging market economies, instability, financial instability is generally comes at a time when there is political instability. Generally, political instability, financial instability, political instability happen, whether it is Turkey, whether it is Argentina, very often, because that's where the uncertainties come. Therefore, in fact, when we had the situation when the UPA government replaced NPA government in 2004, it was the RBI who could get in, because then everybody looks to the RBI. So generally, the feeling in many countries is, the wisdom is that it is better the stability function is separated from the government. In the global practices on both sides, sometimes it's given to, like Bank of England, for instance, all the regulatory agencies are virtually under the Bank of England. Which was separated, now they have been brought back. So anyway, but that is a significant change. So now we have a situation where there is a qualitative shift. Both development and stability is now from a committee, and therefore there is a running of the financial sector reform, and disputes, whatever you have, which means coordination also, is now with the government, no longer with the RBI. I think that I suppose RBI also should realize. Now, there's something else that happened, I think, in 2016, new monetary policy framework. So in the new monetary policy framework, actually what happened is that we got into the, see, on the one hand, we brought in the coordination function as important, took to a high level, took to the government, and then when it comes to the monetary policy, then we said, no, it should be separate. Then we created a monetary policy committee, inflation targeting, flexible inflation targeting, so which strengthened, quote unquote, strengthened the independence of the monetary policy. But in doing so, the new framework has a couple of implications again. In the new monetary, in the new policy, in the new monetary policy framework, it assumes fiscal rules. It assumes fiscal rules, and in some ways, the fisc has maneuverability. In the Indian conditions, fiscal rule is not that binding, and this is computed by the government itself. Secondly, the inflation is influenced, the consumer price index is influenced by two important commodities, food and fuel. And both of them, the prices are determined by the fiscal conditions. So in a way, it is not exactly the same as in other countries. Third thing is that RBI is a full service central bank. In other words, the requirements of coordination between fiscal, monetary, and was being done within the RBI. Now you have created a special place for monetary policy. So there are two other things which RBI always has to be concerned with. One is with regard to external sector. Second is the financial stability. So if we say that governor, RBI is responsible for price stability, this is the target. So then, and also the way it is earlier, monetary policy, all deputy governors were involved, external sector deputy governor. Now, there is an impression gained whether RBI has to treat inflation targeting monetary policy as the major thing. Is there a possibility that we are not giving sufficient attention to, especially in the recent events, some people started questioning whether the financial stability issues as well as the external sector issues, exchange rate. So these are some of the issues that have risen. But in any case, the fact remains that there is a bit of a confusion again here. What is RBI? Is it a monetary authority, predominantly monetary authority, or is it a full service central bank? That confusion has come in, which will have to be clarified. Now, there's another important thing that is unique to India. So because the whole monetary policy committee inflation targeting is consistent with the global best practices. It's consistent theory. We cannot disagree. Whether it is consistent with the requirements is the issue on which there is a debate. Now the issue here is ownership. It so happens that the government owns many of the important banks. Government owns many of the major insurance companies. So you have strong government-owned regulated entities. Now, I'm sure most of the economists here know the problem with regulatory capture. Normally, there is a tendency for the regulated to somehow capture the regulator. Information, they give information, and variety of reasons. There's a whole big theory. By and large, there is a possibility that the regulated captures the regulator. There should be some. Now here, we have a situation where the regulator is the sovereign. I mean, regulated is the sovereign. So you have and we are adopting global principles. Global principles of regulation, they proceed on market logic. Globally, what they say is, if you want less lending to be done, increase the risk weight, then it will affect your profitability. It will affect your profit. Therefore, you will lend less. In India, after this announcement, if the minister comes and says, lend more, they lend more. Every instrument of regulation is built on market principle. A public enterprise gives more priority for public interest. So in a way, you are back to planning era. In some ways, this to some extent it's undermined. No, so therefore, now we are having a situation where there is a coordination done by the government. Government is a regulated. They created a regulator. They created a monitor. So therefore, there is an amount of confusion going on. And therefore, and this gets expressed whenever there is a stress. When there is stress among the units, then it gets expressed as a pressure on these arrangements. And whenever there is fiscal pressure, for instance, the whole issue of reserves, why is it coming up now? So these are the issues that come up. And therefore, the limited point is, if we find a lot of news about the monetary policy and fiscal policy interaction, that news is not because of any personalities or the party or the government or politician or RBI officials having some bad intentions. There are issues which are unresolved globally. There are issues unresolved domestically. And these have to be analyzed fundamentally. Thank you very much, sir. Thank you.